Good afternoon, everyone, and welcome to today's edition of the weekly webinar series. Today's topic provides an overview of how to prepare a rural or critical access hospital to apply for a loan. I'm Darren Simmons, and I'll be your host today. So now I'd like to welcome our presenter. Leading today's discussion will be Hal Fudge from MidFirst Bank. So now, without any further ado, I'd like to turn it over to Hal.
Thank you, Darren, and it's a pleasure to be here today to give a perspective, at least in a commercial lender's viewpoint, on what we think a healthcare provider in rural America would encounter if they were to walk into a bank anywhere and request a loan, specifically probably an EHR loan. Joining me here for this presentation is our point person on EHR lending and its possibilities within rural America, Carol Kinzer. She's our Senior Relationship Manager in Healthcare Lending. I've been asked to put together a package of what I think would be the issues that one would face critical access hospital or any other rural hospital once they enter the doors of a bank and ask for a loan. And some of this may be very basic for those of you who have already crossed over that threshold, so I apologize for those areas that you may have already been well versed at. Commercial banks across the country refer to their process of evaluating a loan request as underwriting. It's basically from the very beginning to the end of the analysis of the request for a loan prior to its going to various forms of approval inside of a bank. So when you go into a bank and you ask for a loan, the underwriting essentially begins right there at the request. Once they understand the request, what typically follows is that a bank will go through the gathering and the analysis of the borrower's financial information. You'll get a long list. Usually financial statements is the basic core piece of information that they will ask for. Obviously, it'll be the income statements and the balance sheets. And once they typically ask for 3 years of financial information, they will begin to formulate the terms and conditions of the potential loan based on each bank's internal policies. They will, number 3, they will assess the overall creditworthiness of the potential borrower based on their analysis. It'll determine to them if the loan has acceptable quality to bear the risks of the credit. They will test the potential borrower's capacity to repay the loan. Obviously, they're not going to make a loan unless there's a good chance that they think it's going to be paid back. And it obviously has to comply, usually, with the bank's internal policies. The next step, as I mentioned, is that they will begin to collect background information on the hospital and its owner. What will follow is the last 3 annual financial statements, as I mentioned, balance sheet information, income statement information, and cash flow information. A lot of times, if you're in the middle of the year, let's say if we're in the summer and they have your last fiscal year end, let's say that your fiscal year end ends on a calendar year end, so your fiscal year end period is December 31st. They will ask for interim periods since that point in time. Usually they will ask for the most recent interim statement. That's usually on a quarterly basis with statements from the same period the last 3 years. What I mean by that is if you have a March 31 statement for 2013, they'll want to see what your March 31 statement was for 2012 and maybe even in 2011. And the reason for that is you might have had a mediocre fiscal year end in 2012, but all of a sudden the first quarter shows that revenues have skyrocketed and income has skyrocketed. Well, a bank doesn't get overly excited about whether the provider is suddenly has improved their performance. What they like to see is, did they do the same thing the previous year in March, but ended up kind of on a mediocre full year? And how they do that is they ask for the same interim period as the previous year. Supporting schedules are often asked for. That would be account receivables aging. Obviously, with HIPAA requirements, they will only ask for your payor. From if it's Medicare or Medicaid or commercial payers. They will ask for your accounts payable aging, making sure that you don't have a lot of vendors that are significantly past due. They'll ask usually for a schedule of existing debts and monthly payments, your capital structure, if you have a mortgage on your real estate, if you have a lot of equipment leases, essentially what are the terms that you're being asked to pay that back. Operating reports are required for the historical periods covered by the financial statements so they can reconcile the gross revenues versus the net revenues. For a healthcare lender like ourselves, we like to dig a little deeper to understand the nature of the revenues. We ask for the net revenues by specialty and by payer type, Medicare, Medicaid, commercial insurance, private pay. And then after you get the historical information, this is where sometimes it gets to be a challenge, is to ask for projected financial information. You know, sometimes hospitals have readily available 5-year projections, and sometimes they only have 1-year projections, but it really helps a lender understand the direction that the hospital provider is anticipating they'll be in 1 year, 2 years, 3 years. With all of the regulations and the pressure from Washington, D.C. upon healthcare providers across the country, we want to see how the provider is dealing with those issues and where they see themselves down the road. That's where a lot of guidance from the lender is often a lot of discussion back and forth helps with a provider putting the financial package together. We want to know what their capital spending budget is. You know, sometimes a older hospital can have a lot of old equipment that is in need of replacement, and that will have to be factored into what their capital needs are in the future. So we will ask them if they're, you know, if we see on their balance sheet that their equipment is essentially depreciated down to nothing, the question will arise, well, is there going to be a need for equipment to be put in at some date, whether it's financed or paid out by cash? And that's usually factored into the projections in the future. The next thing, and we're assuming that this hospital provider enters into the bank asking for an EHR loan, and there will obviously be questions from a lender to ask for information on the purchase, the implementation, and the upgrade of the EHR system itself. Obviously, we'll want to know who the vendor is. Some institutions are not as in-depth in healthcare lending as MidFirst Bank is, so some may ask and want to know the historical performance of the vendor itself, what their backlog is. Are they going to be able to get this implemented in a timely fashion? They'll want to know representations that the system is a certified system, the estimated reasonable cost of the system, obviously, and the timeline for the purchase and implementation. If they're up to date and knowledgeable about EHR, they'll want to know the expected date of first attestation of meaningful use, and then obviously the expected date of receipt of the incentive payment or payments. Formulating the terms and conditions after the financial information is obtained is usually the next step, and it's known as the structure of a potential loan. That's where you get into the terms and the payments and the interest rates, whether it's going to be a revolving loan or whether it's going to be a term loan. If it's a term loan, you will determine what type of amortization period. What that means is it a 2-year loan or a 3-year loan, 5-year loan, and then what the maturity date is. EHR loans are probably going to be a term loan, but there is generally, I think there will be some period of time to allow the healthcare provider to get through the point of implementation and attestation before principal is due. But each lender may have a different format to go by in internal policy. So it probably will not be a revolving loan, which usually is associated with working capital, accounts receivables, where there's no principal payment but interest. And on an EHR loan, I would tend to think that it would be a term loan with a set maturity. And then all those elements are going to factor into the monthly payment. And the monthly payment on an annual basis is what determines what the debt service requirement. Debt service requirement is a term that's used often in banks, and that is just how much principal and interest has to be serviced on that debt. Sometimes the bank will ask for guarantees of the full amount of the loan or specific guarantees. All that is negotiable. If it's a not-profit organization, then obviously full guarantees would not be available. But guarantees is a form of enhancement if there are certain risks inherent in the borrower that's requesting the loan. That would also factor into collateral coverage if there is additional collateral that could be pledged apart from the EHR software. This is where the fun begins, where the bank then begins to examine the trends in revenues and expenses and profit margins over the years. It's the job of an analyst in a bank to objectively look at the information that they just received from the critical access hospital and determine, okay, are revenues stable? Are they increasing or are they decreasing? And if they are decreasing or increasing, what's causing it? And it all drills down to the bottom line, which is the profit margins and cash flow, which is the source of repayment of any loan that's going to be made by the bank. So they will look at the trends. They will probably have questions throughout this process. An analyst may call the hospital 1, 2, or 10 times during a month and ask for explanations or more detail or clarification on what they're finding in their analysis. The bank will then compare the most recent interims to the prior year's interim periods, as I mentioned before, just to see are things relatively stable or are they going in one direction or another, and why. I mean, if there's a slight increase this way or another, it's not going to be much of an issue. If there is a jump from one direction or another, it may not mean anything. Then again, it might, but usually it's a question that deserves an answer. The bank will assess the liquidity and leverage of the hospital's balance sheet, how much cash and liquid assets they have versus how much debt and what we call leverage. You know, sometimes when an analyst would look at a hospital's financial statement, they can see that on the income statement they're making all kinds of money. Their revenues look strong and their net income looks great. But when they look at the balance sheet, they see there's hardly any cash, and there's not much liquidity. And actually, this has happened a couple of times in my experience. And what that usually means is, although they're recording revenues and income, they're not collecting it from the accounts receivables, which could be a red flag as far as are they having problems in their revenue cycle management. The next page is assessing creditworthiness. And that is the next stage of where the bank really zeroes in on the ability of the borrower to pay back the loan. This is very important. And it's got a lot of terms to it. Cash flow, or EBITDA, which stands for earnings before interest, taxes, and depreciation. Available cash to service debt is another term, but it all zeroes in on the same component as far as after all is said and done with revenues and expenses and salaries, how much money is left over to meet the obligations of the hospital. A lot of banks use a lot of different calculations. Usually, if you had a net gain, let's say you sold a parcel of land next to the hospital and it gave you $500,000 in proceeds, that's going to be taken out because that's not really considered recurring. It's not really considered core operations. And on the flip side, if you sold a piece of land and actually lost money, let's say you lost $250,000, which depressed your income for that year, they will add that back in to try and arrive at what is called the core recurring earnings of the hospital. Cash flow available to service the debt usually begins at a measurement where it adds back non-cash charges. There's an example down here of an income statement for a hypothetical year ending December 31st, 2012, where depreciation and amortization is obviously an expense from the hospital, but it's non-cash. So that's added back to get at a level of cash flow available to service debt. You also add back the interest expense because that's part of the debt service. So if you wanted to start from the bottom, as this example shows, net income of $580,000, you add back the taxes, because sometimes taxes are different versus what they file on their income tax versus not. And then you add back your interest expense, as I said, as part of the debt service. It's the interest charge. And you add back amortization of intangible assets and then depreciation of their capital assets, because those are really non-cash charges, or they might be considered reserves. And in this case, a $580,000 net income figure becomes $800,000, which is available to service all of their ongoing needs, such as principal payments and interest expense. The banks will examine the leverage or the amount of debt compared to the income with the financial ratio. We're getting down to the real nitty-gritty of what they're going to determine if this hospital qualifies for a loan. And also, in addition, they'll look at the leverage. Is this hospital got a lot of debt on its balance sheet? And a typical easy-to-understand ratio is take your total liabilities to total tangible net worth. We don't have it here because every bank has a different sense of how leveraged a borrower should be. Obviously, if you had $20 million in assets and you had $10 million in liabilities and you would have $10 million in net worth, that'd be pretty healthy. That'd be 1-to-1. If you have more net worth than liabilities, you're really in a good leverage position. In fact, one would say that you're not leveraged. When you get above 3-to-1 or 4-to-1, then it's considered to be fairly leveraged. And any higher than that, it does create a red flag. Doesn't necessarily disqualify anybody, but it is a question that needs to be answered regarding the leverage of the hospital, all that debt on their books. So if you had $40 million in liabilities to $10 million in net worth, you would be considered highly leveraged. Now I'm on page Access Capacity to Repay the Loan. This is where it gets down to probably the most important ratio, and there's a lot that factors into determining whether a borrower would qualify for a loan. But leading up to the determination of cash flow, that calculation that I did on $800,000 EBITDA available to service debt comes down to a ratio that banks typically use called debt service coverage ratio. And it's really simple. It's just taking what I described as earnings before interest, taxes, depreciation, and amortization, which is commonly referred to as EBITDA, by the debt service. And debt service is defined as the total of all monthly principal and interest payments on all loans, as well as capital leases, if you have capital leases that are on your balance sheet and not run through as an operating lease expense. So if you had your EBITDA, which in our example was $800,000, and let's say your total debt service was, say, $666,000, you would have a debt service ratio of 1.2, which is really, it's a common standard minimum of what is considered to be a healthy operation. Anything below that, you get into a kind of a yellow light. Anything above that's a green light. And if you get down to 1-to-1, you really start getting to a red light, because that is break even. And if you're below 1-to-1, that calculation shows that the hospital does not generate enough money on an annual basis to meet dollar for dollar their obligations, which is obviously a red flag. But as I said before, each bank may have a different standard. One may have 1.15 or 1.1, or other banks may have 1.3 to reach that threshold of what they consider to be healthy. And not reaching that threshold doesn't necessarily disqualify somebody immediately. It just takes a little bit more work to mitigate that red flag. Then there's obviously the collateral, evaluating the collateral. But before I get to that, I made some calculations today that I thought would be a little bit more insightful as far as what I just said about the EBITDA and the debt service coverage ratio and how it's important with EHR lending requests. If we went back to our example of EBITDA of $800,000, and if you had, as I said, $666,000 in debt service on an annual basis, you'd be 1.2. Well, let's say that your debt service is $500,000. Well, that's a 1.6 debt service coverage ratio. That's very strong. Well, now let's say that you do walk into the bank and you say, I want $750,000 for my EHR loan. The bank says, well, I can probably give you that on 60 months at 5%. Well, if you calculated what the debt payments would be on a $750,000 loan for 5 years at 5%, that would be $14,000 a month. That would be $170,000 a year. So back to my example of EBITDA is $800,000, debt service is $500,000. Now you got to add another $170,000 to the $500,000. That means you would be $670,000 in debt service. Your debt service coverage ratio goes from 1.6 to 1.19. It's below the 1.2, which a bank may start to be a little bit uncomfortable. However, you're going to also say, but of that $750,000 loan, I'm going to get $600,000 or $650,000 back from Medicare and Medicaid to offset my capital cost of the EHR. If you factor that into an outside source of income that is going to be coming from something other than core operations, and that amount's used to pay down that EHR loan, well then and let's say you had $100,000 left over that you had to have to pay out over 5 years, your debt service coverage ratio goes back up to 1.53. I can provide the calculations if I went too fast, but what I'm trying to get across is your debt service coverage ratios that a lender is going to look at is he's going to look at the revenues and the cash flow being generated on a recurring basis, is what we commonly call core operations, compared to the weight of the debt that it must service. And if it's over 1.2, it looks pretty good. When you lay on another amount of debt for EHR without factoring in the incentive payment, it would depress that figure to a point where it might not look attractive to a lender. And that's why you are really enhancing the prospect of getting that loan when you factor in that, well, majority of that's going to be offset by the government's program, their incentive payment. So all that has to be presented to the lender if he doesn't understand that. Otherwise, he will just say, well, if you factor in that new debt, that gets your ratio down below 1.2. Now, if they don't understand or they need to be convinced a little bit more of how to enhance the loan, they would probably look at collateral. Is there additional collateral to be had? Is there some land? Is there some equipment that's been paid off? Are there some guarantees that can be provided? All that could be used to enhance the position of the lender that could get him over the threshold of granting that loan.
Great. Thank you, Hal. And thank you all for participating today. We really do hope that you enjoyed the session. Please email the HITRIC training team if you have any questions. And thanks again for joining. We look forward to seeing you again on future webinars.